People hate inflation because they don't understand inflation's effect at scale. They are too small minded and they only think how inflation affects them in the current moment and how price hikes are going to make their lives harder. Yes, your purchasing power does drop, but what high inflation means is that the consumer is spending. That means we have an active economy where people are actually buying stuff and aren't scared. More spending means more economic momentum and happier consumers. Inflation also suggests more risk on behavior than risk off. What's actually worse is disinflation. When people aren't spending much, the economy tanks. Now we're going to touch upon the concept of real yields. What you yield on a risk free asset like bonds, say something like 3.5 to like 4.5% per annum, is what you yield on bonds. Your real yield is that adjusted for inflation. So, whatever that yield is subtracted by inflation, that's your real yield, or that's actually how much you yield on the bond. So, when you subtract inflation from that risk free rate, that number is lower. So, that just means that your effective real yield drops. Now, that is bad for bonds, but that means that's great for equities because people are going to start rotating their capital into more equities than the bond market. That is great for gold and that is great for equities. Gold benefits from a declining real yield. Not only that, but it's also a great inflation hedge. With higher inflation, the price of gold also rises. So, in that scenario where we have inflation rising, that is great for risk on assets and for gold. In fact, one of the things which is most paid by Wall Street fund managers is a CPI nowcast. Fund managers trying to predict how inflation is going to change on a rate of change basis. One of the indicators which really front runs how inflation and CPI, what the CPI number is going to be, how professional traders do this, is by looking at the price of oil. That's the secret. That's what professional traders look at to front run inflation and accordingly position their book. Now, inflation alone doesn't mean anything. You want to look at it along with which growth cycle we are in right now, the liquidity in the market, and how earnings are doing right now. If you want to learn exactly how you can front run market crashes and exactly how professional traders incorporate these multiple indicators into getting a proper market view, in the description below, I have a free PDF which tells you every single indicator which has successfully predicted every single market crash since 1955. If you want to front run the markets, you want to see that playbook.